Hi, folks. Dan Bird here on Sunday, January 28th, almost the end of the month. I am doing this solo today, so hope everyone is listening. Mr. Zuber is off celebrating his wife's birthday today, so happy birthday, Olivia. So I'm going to do two sessions. The first one, I want to talk about the presidential cycle and how that affects the stock market. And then the second one, I want to talk about some of the scans that we talked about last week and introduce a new one for this week. Both of them should be pretty brief. So let me get started. I'll share my screen and take a look at the website if you're interested in getting the newsletter. I actually talked about the presidential cycle quite a bit in the newsletter this week. So if you want to read more about it, just click that button right there. Go to breakpointtrading.net. One thing that I added this week is an options page, which is still kind of a work in progress, but I'll be adding things to it. Kind of explains what options are, explains time decay, takeaways, vertical spreads, how they work, cash settled index options, which actually gives you a tax advantage. So if you use options for cash settled index options, like the S&P, the NASDAQ, and the Dow, you can claim 60% of it as long-term capital gains, regardless of how long you hold it. So you can have it for one day and you still get 60% of it is long-term capital gains. So that's a nice advantage. And then down here, I put in what the bias looks like, short-term, medium-term, long-term, and the early warning on each of these symbols right there. The Greeks explain those a little bit. They can be a little confusing, but there's only a couple of them to really focus on. Most importantly is delta. So this explains what those are. And then moneyness, which is in the money, out of the money, at the money. I actually put an example here using Toll Brothers, which just so happened to be exactly at $100 that day. So it was a really good example. And I show what it means if you have a call on the left side or a put on the right side, what it means to be out of the money, at the money, or in the money for each of those. And then how you should look at delta to understand where to place the trade and understand what strike price you should put it at. So this is just really an educational section on the website. All right, let me go talk about the presidential cycle. So this is January. We are right here. We've got a couple of days left. 3 days left in January. Fed rate hike is at the very end. It's actually the first day of February. Everyone is expecting them to hold steady, no further hikes. As I mentioned last week, I think there is a very outside chance that they might hike one more time. In fact, technically, they're at 5.33%. So they could say, well, let's add another 0.15. And there's nothing that says they have to do a quarter or 50 or 75 or whatever. They could say, let's just do a 0.15 and make it an even 5.5%. I don't think they'll do that, but they could potentially. There are some reasons why they might hike. All the numbers are coming in much stronger. Inflation was hotter than expected. GDP was hotter than expected. The jobs number was hotter than expected. The economy is still rolling along pretty well, pretty hot actually. So they might want to just have one more rate hike just to let the market know that they're serious about inflation. We'll see. They probably won't, but I put it out there last week, and I'm saying 5% chance that they might still. Anyway, that's where we are for this week. Where we are for February. By the way, take a look at what the market has done. Again, this goes back to 1950. The dash lines are 1950 for election years. That's important because there's a few things I'm going to show you about that from 1950. So that's 74 years ago. And then everything else this is for the NASDAQ. So recent performance is 21 years since 2003. And it has a little sell-off in the beginning of the week, and then starts to go up a little bit right at the end of the week. And then here's where we pick up in February. There's the rate hike. Kind of goes sideways for the first week of February. Then we have a little bit of a rally. The inflation report is on the 13th. I expect that to be softer than expected. I think it's going to actually come down quite a bit. I don't think it'll break 3 yet, but it's going to come down at near 3 or 3.1, I think. So that's actually going to be good for the market. And then options expiration is right there. And look at this date. This is right before President's Day. Options expiration date, February 16th. Keep that date in mind when I show you some of these other charts. And notice what happens in February. The market starts selling off right there. Now, it's very interesting what happens during election years in both the March and the October timeframe, September, October timeframes. So let me show you that. So here's the 4-year presidential cycle. This red and blue and green line right here is where we are right now. So that's from 2021 to 24. So that's the 4-year presidential cycle. Usually the 3rd year of the cycle is usually the best of the 4, actually. And that's 2023, and you can see that right here. So if you'll notice the dashed lines in the background, those are the trends going back to 1950, going back 74 years. So the dashed lines in the back are the trend. Don't worry too much about following those exactly, but just look at the pattern. Just pay attention to what the pattern looks like. So you can see right through here, went sideways, actually came down here in March, came down here in October, started to climb again. In 2023, these are the actuals, what actually happened just last year. This is October. This is when we hit the low, right in October, and started climbing into the end of the year. So here's 2024. This is the year that we are currently in. Historically, the market usually ends higher. Usually it doesn't do as well as the previous year, but it still does well during the last year of the presidential cycle. 2 things to notice. Look at this period right here. So we are right about here, just before this little peak. That's what I showed you before for February. So that's right around the middle of February. And then in March, we have a sell-off. Now this is going back 74 years. And then we have a rally into about September, and then a sell-off right before the election. It kind of makes sense because the markets do not like uncertainty. And there's no way to tell for sure who's going to win the election, so they don't like uncertainty. I'll talk more about that in a second. But right around August, September timeframe, it sells off until October, and then November, right after the election, it takes off again. So and that makes sense too, because after the election, then now there is certainty. This is regardless of who wins, regardless of whether it's Democrat or Republican, does not make any difference. This is just the 4-year cycle going back 74 years. So this is where we are right now. We're following it pretty well. We're coming up to that middle of February, March timeframe right here. All right, so this is last year. This is the 3rd year. This is the pre-election year. This is for the NASDAQ. And here's what the NASDAQ did. It was, this long from July until October, big sell-off. And then October was the bottom, and we took off. The blue line is all pre-election year. So the blue line and the purple line is just for 23. The blue line is all the way back to 71. So you can see it, the pattern. Again, don't follow the exact lines because this line represents multiple years, whereas the purple line only represents 1 year, 23. But look at the patterns. So came down right here. This one came down a little bit earlier in August, had a little bit of a rally. This one rallied and started coming down earlier, but both of them ended right here in about the 3rd week of October, and both of them then rallied into the end of the year. So last year pretty much followed the trend. So this one is really interesting. This is Tom Bowley, who does earnings beats. He created, using all of the data going back to 1950 just for election years, he accumulated all of that data, took the averages for every year, put it into a spreadsheet, and then in stock charts, it gives you the ability to create a custom chart or a custom index using that spreadsheet, using an Excel spreadsheet. So that's what he did. This is all the average years of every election year going back to 1950. So averaging all of those out over that period, this is what the pattern looks like. First of all, So this is the year that we're in right now. This is what we should expect, something reasonably similar. Of course, the market does not have to follow this. The market could go higher or lower in either case, but this is the average for the last 74 years. So first of all, notice here the third week of February, there's the peak, and then a big sell-off into the middle of March. Very similar to what I showed you on those previous charts. And then it starts to rally, has a nice rally, a little bit of a pullback in May, but continues to rally all the way into September, just before the election. And then in September, sells off pretty dramatically into the third week of October, which is very much what happened last year in 23. But this time we have an election right here in the first part of November. And then after the election, going back 74 years, the market then rallies toward the end. So just paying attention to the pattern, notice the October low and the March low right there. Something to not saying again that it's going to do that this time, but it's important as traders that we keep these patterns in mind. So here's the election year seasonal pattern. We are back here in this pink line, all the way back here in January. We're actually almost into February now. The green line is when a sitting president is running. That's what we have right now so far. The black line is all election years. That's with a sitting president or not. And then the blue line is the aggregate cycle. So two lines to pay attention to: the green one, which is when a sitting president is running, and the red one, which is an open field, meaning there's no incumbent running. It's an open field with multiple players potentially. So that's the worst case for the market. The best case for the market is an incumbent president running. Right now we're right here, so we're following that trend, that green line so far. Sorry. Right here in the middle of February, just like I showed you before, that's where it hits the peak, sells off in the middle of March, and then starts to climb back out again. In this case, with an incumbent president, when we get to just before the election, it sells off a little bit, actually goes sideways through there, and then right after the election takes off. But what happens if it's an open field? We still get the sell-off here in March. Now, right now we're in this green line, so the red one doesn't apply. But if at some point, and let's say that point is right before the convention, let's say Biden decides, maybe he is too old, decides to step aside and anoint someone to take his place, like Gavin Newsom or someone else. And that person that steps in, while they will have the endorsement of the incumbent and probably have all the funding that the incumbent had accumulated, they are not the incumbent. So then we switch down to the red line. And if something happens to Trump too, Trump, even though he's not the incumbent, if we get a situation where neither one of them are running, which I think potentially could happen right around the conventions, which usually is right in August, then we switch from the green line to the red line. And then we've got this big sell-off here in October, just before the election. And then after the election, like most other election years, the market then takes off. So those are some things to watch, some things to be aware of as we go into the election year. Let's take a look at the January Barometer, Santa Claus Rally, and January to see how we're doing. So as I mentioned last time, the first two are negative. Santa Rally is -1%. First 5 days of January is -0.13%, practically flat, but technically it's minus. But January so far looks pretty good. So 2 out of the 3 negative actually implies we will end higher. In fact, potentially we could end 20% higher by the end of the year. So keep an eye on that. I have this chart on my website, so you can continually look at it and see how we're doing. We only have 3 days left in January, so I'm pretty confident we're going to end up positive for the month of January, for the full month, and that should be good for the market. This is, again, the January month tracking with the election year pattern. You can see the solid lines are going back to 1950, and the dashed lines are where we are right now. So this is for the Dow, the NASDAQ, and the Russell. So right now we are pretty much tracking right along with the election year cycle. Through the end of January, which is actually, we're over here. There's only 3 days left over here. So we've got a sell-off right here going into next week. And then right at the very end, a little bit of a bounce. And this will take us into February, the chart I showed you before, where the first couple of weeks of February actually might be positive until we get to that middle point of February. So right now, things are looking pretty good. This shows you, especially on the right-hand side, this shows you what happens historically when 2 out of the 3 for the January indicator are negative. But the third one, the full month of January, is positive. And what happens when 2 are negative and 1 is positive, the average gain for the full year is almost 20%. And for the last 11 months, this is February to December, it's up 15%. That looks like what we're going to end up with. So that actually could be pretty positive for the year. If they both end up negative for some reason, if the last 3 days has a big, huge sell-off, and we get all 3 of these negative, then on average, again, going back to 1950, the market ends up down 3.6% for the rest of the year. So we do not want that to happen. And so far, it looks like we are looking pretty good. If I actually go over to the website on the chart section, that's why I have the Santa rally. So here's 2023. All 3 of these were positive, and the year ended much higher. For 2024, this is where we are right now. The first 2 were negative, but it looks like the third one, we've only got 3 days left. It looks like that one's going to end positive. So that's good news. That implies a 20% gain for the full year. And I don't know what this percentage is. As soon as we end January, I'll put the actual percentage in there of what the gain for January was. But, you know, figure that, and then the full year of 20%. In general, that's the average over time. So it looks pretty good. So keep that in mind. Keep the presidential cycle in mind. It's important to understand history. You know, those who understand history can profit by it. That's a quote from Stock Trader's Almanac. Those who understand history can profit by it. So keep that in mind. Hope everyone stays well. I'll do one more session about some scans. I've got a new scan that I created, and I'll talk about that one in a little bit, and I'll try to explain the one I talked about last week, because some folks were a little confused by it. So hope everyone's doing well, and we'll talk soon. Take care.